For the first time in 4 years, the US Central Bank has announced an interest rate cut of 50 basis points to a range of 4.75 to 5%. The next day, the prime rate was cut from 8.5 to 8%. This is the first rate cut in the US since March 2020. Interest rate cuts have an impact on everything in your life, ranging from inflation to loans, credit cards, foreign exchange rates, the stock market, employment, and real estate. Let's talk about all of these things today, but most importantly, how the interest rate cuts impact you and your finances. If you're new here, my name is Alice and I'm a chartered professional accountant, and on my channel, we discuss personal finance and business. If you find my content valuable, please consider subscribing to the channel and turning on the notification bell. So how do rate cuts actually work? Overall, the reason that the feds are doing this rate cut is to stimulate the economy and increase your spending power as a consumer. When the Federal Reserve cuts interest rates, they are increasing liquidity into the US economy, which makes money cheaper. This Fed funds interest rate, otherwise known as the overnight rate, is the same rate that commercial banks charge each other for overnight lending. The prime rate, which is not the same as the Fed's fund rate, usually follows the overnight rate, and that's the rate that your bank uses to determine how much interest to charge on your credit cards, your mortgages, and other loans. The prime rate is typically 3% higher than the federal funds rate. That's why, as of today, the Fed funds rate is between 4.75 and 5%, and the prime rate is 8%. It's about a 3.25% difference. I am sure that you have felt the impacts of inflation in the past few years. The prices of everything have gone up. It's been one of the hottest discussion topics. Inflation is a pretty complex subject. There are a lot of variables that can impact the price of goods and services in an economy. One way that you can see it is that inflation occurs when the money supply of a country grows more rapidly than the economic output of that country. And how we measure inflation is through two primary indexes in the US. The main one is called Consumer Price Index, and the other one is called PCE, Personal Consumption Expenditures. They are basically two methods that are used to calculate and track inflation. Both CPI and PCE peaked in 2022, meaning that in 2022, that's when inflation was the highest. But both have been coming down slowly since then, which is a good sign. In fact, in the August 2024 CPI report, CPI came back at 2.5%, meaning that the 12-month trailing inflation rate was 2.5%, which is the lowest that it's been since 2022. Now, with this rate cut and with the feds trying to increase liquidity into the US economy, this increases you as a consumer's spending power. So just to explain the theory, if the total supply of goods in the US economy remains the same, but interest rates are now lower, this actually pushes the price of goods and services up. But because the feds have made this rate cut, it signals that they're expecting the level of economic growth that will result from the rate cut will be equal to, if not greater, to the level of money supply, which is how prices remain stable. This is because the Fed has two primary goals behind their decisions on monetary policy, one of which is to keep inflation at 2%, and the other is to maintain low unemployment rates. Overall, in summary, the Fed's cutting interest rates is an indication that the Fed believes inflation is expected to be under control, and because of this, there is speculation of further rate cuts that will be happening later this year. Let's talk about impact on jobs in the labor market. When the cost of borrowing decreases, we can expect that companies will want to start spending and start hiring. Right now, the current unemployment rate in the United States is 4.2%, which is a bit higher than it was last year, but it's still considered relatively low overall. In theory, with a rate cut, we can see the demand of labor going up, potentially leading to a more competitive job market. Employers may need to offer higher salaries to attract and retain talent, which could strengthen your bargaining power as an employee, and there could be a bigger push by employees to ask for larger salary increases so that they can maintain their purchasing power. Again, this is all assuming that in the labor market, there is now greater demand than supply. So if you are looking for work or looking to change jobs, interest rate decreases are generally good signs. Now, what about housing? The 30-year fixed mortgage rate is currently between 6.1 to 6.2%. This is still considered very high relative to pre-2020 interest rates, but it's definitely lower than what it peaked at in 2023, which was 7%. Now, while the overnight rate does influence movement on home loan and mortgage rates, there are some other economic factors that might impact the housing market as well. But typically speaking, Lower interest rates lead to reduced mortgage rates. And if you already have a mortgage that's on a variable interest, that's definitely a good sign. It means that you can now expect to pay less interest on your total payment. If you have a high interest rate, you may be thinking about refinancing. Just remember that there is a cost to refinancing, so make sure you weigh that cost to the decrease in the interest rate to assess whether it's a good decision for you. Now, if you are not in the real estate market, but you are interested in buying, interest rate cuts can help more first-time buyers qualify for mortgages. But lower interest rates can also cause increased demand and competition with buyers, meaning that you will need to find a good realtor that knows the market. And if you're in the market, make sure your credit score is in good order. If you are in the market for selling, typically with reduced interest rates, we can expect to see higher prices and a more active market, which is good for sellers. Now, if you are shopping for a car or thinking of buying a vehicle, this is good news for you. I have a video up top here where I talk about whether you should lease finance or buy a car. However, auto loan rates also don't decrease overnight. There tends to be some lag time between the Fed's interest rate cut and what auto loan lenders offer you. Now, anytime the cost of borrowing decreases, it's generally seen as a positive sign for the stock market, and there are a couple of variables at play. The first is at the company level. When the cost of borrowing is down for companies, they will be forced to make decisions on how they allocate their capital. This means that they may consider taking on new debt or refinancing their existing debt, which means that they can increase their cash flow. One type of company that is definitely going to be impacted by lower interest rates are those that are very debt heavy and use a lot of borrowed capital, or otherwise very interest rate sensitive. So this includes real estate companies and REITs. All else equal, lower interest rates can potentially boost company stock valuations on paper because the value of future cash flows is higher when interest rates decrease. Now, what about your savings account? You might have some cash sitting around in a high interest savings account. So yes, you might see your interest rates decrease, and you can also consider moving your cash into other investments. If you're interested in certificate of deposits, you can consider potentially a CD ladder, which is just a strategy meaning that you buy multiple certificate of deposits with different maturity dates, kind of like a waterfall. Now let's talk about personal debt and loans. Interest rates on your lines of credit and your personal loans should go down, providing you with some relief on your debts. Now, credit cards have hit a record high in the past few years. According to Statista.com, it is 21% right now for a new credit card. So if you buy a brand new iPhone 16 for $1,500 and you don't pay it off right away, that's $315 of interest that you have to pay. It doesn't include Apple Care either. According to LendingTree.com, America's total credit balance is $1.14 trillion in the second quarter of 2024, which they took from consumer debt data from the Federal Reserve. This balance is actually the highest balance since tracking begun in 1999. So if your credit card bills are high right now, I encourage you to try to pay down your credit cards by highest interest rate first if you can. Interest rates, inflation, and exchange rates are all highly correlated. There are a lot of factors that impact the US dollar, especially when it's compared to the currency of another country. But generally speaking, when we have lower interest rates, it actually leads to less foreign investment because foreign investors are now being paid less on their investment. That actually causes demand to decrease, and it causes the price of the US currency relative to another country to decrease. So this means that if you as a US citizen are traveling outside the country, it could cost you a little bit more in foreign exchange. On the other hand, lower interest rates tend to be a good time for other people to travel to the US. I hope you guys enjoyed this video today. It has been many, many years of high interest rates and stressful financial times for many people. And hopefully it is a sign of more good things to come for the US economy. I released a new video last week explaining how I budget and manage my money. So if you'd love to learn more about my approach to money management and cash flow, then you're going to love my video up top here. Let me know down in the comments below what points of this video resonated with you most, and I'll see you guys in the next video. Until next time.